updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Stocks are higher on a busy week for central banks. Wall Street's looking ahead to Wednesday's Fed decision and the news conference with Fed Chair Jay Powell. Seema Shah is chief strategist at Principal Global Investors.
I don't expect Powell to do too much. We know that he's going to repeat the message about having to, they've made great progress, but there's a little bit further to go. So I think what we're hearing now is, and at least from a market perspective and where the difference in expectations, where the market can go, is really about what happens at the back end of 2023. So I think that's what I'm going to be looking at for.
Right now, the 10 years yielding 3.61%, with the 2-year 4.40%. Stocks higher across the board. S&P up now, up 26 points at 3960, higher by 0.7%. The Dow is up 302, higher by 0.9%. Nasdaq up 49, again there at 0.5% higher. Spot gold at $17.79 the ounce, down $17, down 1%. West Texas Intermediate crude up 2.9%, $73.12 a barrel on WTI. Microsoft has agreed to buy a 4% stake in London Stock Exchange Group in a $2.8 billion cloud computing deal that pushes big tech further into financial markets. Microsoft now up by about 1.8%. Thoma Bravo has agreed to acquire Coupa Software for an equity value of $6.2 billion after outbidding Vista Equity Partners. Coupa up now by 26%. Recapping, the Dow's up 300 points, up 0.9. The S&P up 0.7. 10-year yield 3.61%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Bloomberg Business Week is brought to you by the Jewish Communal Fund. For 50 years, JCF's donor-advised funds have been helping families create charitable legacies. Start now and open a JCF fund before year-end. Visit jcfny.org. Well, you may remember just a couple of weeks ago, we shared the heartbreaking and tragic story of how TikTok's viral challenges are luring young users to their deaths. That piece was by Olivia Carville. She's back with us this afternoon, and she's back on the TikTok beat. This time, it's about young creators who are posting suggestively sexual content, sometimes with actual parental approval, and how that's leaving moderators and executives unsure about what to do. Joining us now is Olivia Carville. She joins us from New Zealand. We're also joined by the editor of Business Week, Joel Weber. He's a bit closer to home with us right here in the Bloomberg Interactive Brokers studio. Joel, the story centers around a creator who goes by the name Jenny Popach. Who is she?
In real life, Rosalie Aratola. And what Olivia has done here in her second installment on TikTok, the previous one was a cover story in the magazine, is really root us in a uniquely American story, I think. Obviously, TikTok has now grown into the world's most popular app, more than 1 billion people using this. And it's been really profound in sort of the younger generations, right? And we are seeing influencers go, and part of what has made it so alluring is that people can go from like no following to massive following very quickly. That app and its algorithm really prioritizes discovery. And that's allowed a whole new generation of influencers to come up. And Jenny Popach is one example of that. It also shows that there's some real controversial ideas and sort of a darker side of TikTok that Olivia's story goes into. So Olivia, how did you discover Jenny Popach and the controversy that's surrounding her?
Thanks, Joel. Yeah, I really wanted to get a sense of what happens when teenage creators on TikTok are doing sexually suggestive or inappropriate things. And I had been using TikTok for a while, looking at a number of accounts, and I kept seeing a lot of creators criticizing this one particular young teenage creator, Jenny Popach, and I would see a lot of people highlighting her account and raising it as an issue of child exploitation, saying they thought that she was in danger, that she was being forced to perform, that maybe people needed to even call child protection services. So as I was on TikTok and I was watching all of these videos highlighting or raising awareness of this one, what they viewed was a problematic account, I decided I wanted to try and find the teenager behind that account. I wanted to know who Jenny Popatch was. Was she really in danger? Was this all just a big conspiracy theory? What was going on with her account and why was it so controversial? And that led me down to Orlando, Florida, where I got to spend the chance of a week with Rosalie Aratola, the young creator behind the account, to hear her side of the story.
Well, I mean, I was so fascinated to read this story. I was saying just before this segment started, I got served one of her videos on my For You page yesterday, and I don't dance. I don't know why this was given to me, but when you actually
Will you
sat
explain
down,
what the For You page is, though, for people who don't necessarily
you open your
TikTok?
TikTok app and you land on a video, and then you continue to scroll down, and it's just an endless scroll of videos.
And it's really powerful because it gets in front of a lot of eyeballs.
Exactly. I mean, most of the videos on your For You page are there because they've somehow already garnered a lot of views. But tell us a little bit more about Jenny and whether actually she does feel unsafe or whether this is of her own volition.
Yeah, well, so Jenny is, she just recently turned 16 and she has been performing on TikTok and its predecessor Musically from the age of 10. She would do belly dancing videos as a 10-year-old girl and had about 500,000 followers back then. And as she moved, as Musically merged into TikTok and TikTok grew more and more powerful, you know, today it's almost the world's biggest addiction machine for children. As more and more people signed on to the platform, it's got over 1 billion users now. We saw Jenny Popatch's profile just rise in followers. She became quite famous on the app. She's getting a lot of brand deals through the app. People, like different fashion companies are paying her. And she really believes that the content that she's putting out there on TikTok is what all other teenage girls are doing. She feels as though it's unfair that she's being penalized or criticized by other adult creators because maybe predatory men are looking at her account inappropriately. She thinks that that's not her fault. She should be allowed to do whatever it is she wants to do on the app. And if someone's going to view her content through a lens that might be inappropriate or sexually suggestive, that's not on her, it's on them. And I was quite surprised when I met her how eloquent she was and how she really had quite a strong and empowered viewpoint on this. So she feels like she wants to use TikTok to build her career, to make money, to do everything she possibly can to become social media famous. It's been something she's been chasing for a number of years now. Her current account has over 7 million followers, and she wants to keep on performing on TikTok, regardless of what all of her, as she dubs them, haters, think about her and the content that she's putting out there.
So 7 million followers, definitely a lot of haters, and as the headline makes clear, there's also one proud mother. Talk to us about Rosalie's mother and sort of the relationship between her and her daughter.
Yeah, I think one of the most problematic things about the Jenny Popatch's account is a lot of people will view that content and question, where are her parents? How are they allowing her to twerk in string bikinis or body roll in hot pants or wink whilst licking a lollipop with a caption that says, when men can go to jail for being with you? How is it that she's posting this content and her parents aren't telling her to take it down? And the truth behind the Jenny Popatch account is that the parents are encouraging her, supporting her. They're very proud of her and the following she's managed to reach on TikTok. They think it's great that their daughter has 7 million followers and is making money on the app, that they're hoping she may use one day to go to college or further herself in whatever career path she chooses to go down. And when you actually go deep into the rabbit hole of the Jenny Popatch account, which I did for this story, I've watched hundreds of hours worth of her videos, you can see her parents right there from those early stages, kind of rooting for her and encouraging her to keep performing and keep reaching that social media fame level.
Olivia, we got to leave it there. That's Olivia Carville. She's an investigative reporter for Bloomberg News, joining us from New Zealand. Also, along with Joel Weber, the editor of Bloomberg Businessweek. The story is online. Check it out at bloomberg.com/businessweek. This is Bloomberg.
taking a look at some of the other stories that are making news in and around the New York City area. Today we've got the S&P up now by 28 points. That is a gain right now of just about 0.7%. Some of the other stories, Goldman Sachs aiming to cut at least a few hundred more jobs as the Wall Street Titan restructures its struggling consumer business and braces for an uncertain economy in the year ahead. Also, Amgen has agreed to buy Horizon Therapeutics for about $27.8 billion in its biggest ever acquisition, outlasting at least two other suitors for the developer of autoimmune disease treatments. Amgen will pay $116 a share in cash for a premium of about 48% since Horizon Therapeutics disclosed on November 29th that it was in early talks with three suitors. The announcement confirms an earlier report by Bloomberg News. Amgen today is trading lower by 1.3%, Horizon up by 15.4%. Microsoft has agreed to buy a 4% stake in London Stock Exchange Group in a $2.8 billion cloud computing deal that pushes big tech further into financial markets. Microsoft shares up by 2.2%. And those are some of the company stories that we're following at this hour. I'm Charlie Pellett. This is Bloomberg.
This is Bloomberg Business Week with Carol Massar and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
It's Bloomberg Business Week. Tim Stenovic and Katie Greifeld in for Carol Massar this afternoon. Let's get an update on world and national news. For that, we head to our 99.1 newsroom in Washington, D.C. Hey, Nancy Lyons.
Thanks, Tim. AAA is out with travel estimates for the holiday season, with the number of Americans heading to their destinations by car, plane, and rail all on the rise. Alan Edmonds is the association's external communications director.
This holiday season, air travel will see a jump over last year, increasing 14%, with 7.2 million Americans expected to fly. Flights and airports will be bustling and look a lot like they did pre-pandemic.
Edmonds says the number of people traveling by car is expected to be up 2% from last year. The European Union is hoping to reach a deal tomorrow on its plan to wean itself off Russian fossil fuels. Belgium's energy minister, Tina van der Staten, tells Bloomberg gas supplies seem adequate for this winter, but leaders will need to address future supplies.
We have filled our storages, we have decreased our demand, and yes, there is another winter coming, and preparation of the next winter is also being done now. Like, for example, joint purchasing of gas is something that will be discussed tomorrow at the Energy Council.
Belgium's energy minister, Tina van der Staten. Scientists in California have made a breakthrough in nuclear fusion technology. Bloomberg has learned that for the first time they've produced more energy than consumed in a reaction. It took place at the Energy Department's Lawrence Livermore National Lab near San Francisco. Former EPA Administrator Christine Todd Whitman tells Bloomberg it's an exciting development.
This is a big step forward, and fusion can certainly offer a major tool in the efforts that we need to make to address the issue of climate change and what's happening in the environment.
Whitman says while the results are considered an achievement, we're still a long way off from creating a viable technology. The Keystone pipeline that carries oil from Canada to U.S. refineries is still shut down after a major oil spill, and officials with TC Energy say it's not sure when it will be restarted. The company will need regulatory approval first. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. Back to Katie and Tim.
Thank you so much for that update, Nancy Lyons. Really appreciate it. Katie, it's been almost an hour in the program, and we haven't talked about the initials SBF or FTX.
I know, I feel so itchy. I'm glad we're going to talk about it right now because it's a big week for a number of reasons. When you think about CPI, when you think about the Fed, there's something else going on in Washington.
A lot of initials.
Yeah, 3-letter words.
What do you call it, alphabet soup?
Alphabet soup. But in any case, we are going to have SBF join the House hearings. I believe they're tomorrow. He's not joining the Senate panel, but he is going to join the House hearing. So we're going to hear from the man himself, but I believe it's going to be virtually. I don't think he's going to be there in person.
He confirmed that he will attend the Tuesday hearing by the House Financial Services Committee remotely. He's listed as a witness alongside current FTX CEO John J. Ray III. That's according to a media advisory from the committee. Starting at 10 a.m. in Washington, the House hearing will be split into two parts, each featuring one of the men. Ray, in remarks prepared for the House hearing, blamed FTX's collapse on the failures of its previous leaders. Katie, the other thing that gets my attention is this story that we have on the Bloomberg by Laura Davison, Bill Allison, and Allison Verspril, all about how the millions of dollars that FTX and Sam Bankman-Fried gave out in political gifts are right now at the risk of a clawback through bankruptcy.
Yeah, I love the phrasing in here. Washington's brief but intense flirtation with FTX donors definitely delivered a lot of money into the pockets of Washington, but in bankruptcy, that looks a little sketchy.
Yeah, it does. Look, the story's still unfolding.
Mm-hmm.
We don't know what's going to happen. I think we all will be tuning in tomorrow morning when we do hear from the man himself. Virtually. You're listening to Bloomberg Business Week. Coming up next, we're joined by our friends at Bloomberg TV for our countdown to the close. This is Bloomberg.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
And right now, we have about 60 minutes left here in the trading day. Romaine Bostic alongside Scarlett Fu. We're counting you down to the close here and joined right now by our colleagues Jim Stenevik, Katie Greifeld in today for Carol Massar. Welcome to our audiences across Bloomberg Television, Radio, Quick Take, as well as all those folks who are some reason logging in on YouTube. Tim, a pretty wild day here, and what I'm told is the most consequential week ever for markets.
I mean, I guess that would make sense given what we have coming, CPI tomorrow and then the Fed on Wednesday. But we kind of know what the Fed is going to do. I think the big question has to do with the way that Fed Chair Jay Powell talks about how he's moving forward to February, and if he doesn't squash the rally that we've seen over the last few weeks, last week notwithstanding, Katie.
And if he does try to squash that rally, will markets even listen? There's a lot that could happen. There's a lot that could go wrong. And of course, the week starts tomorrow with U.S. CPI figures. So got a lot of fun ahead.
Yeah, and we should point out, too, I mean, this is kind of bookends the year. Because if you remember, I think it was something like that last week of January where he came out and kind of made that what a quote-unquote hawkish pivot. He didn't raise rates then, but he basically made it clear they were going to at that March meeting. And then it was, and he said at the time they were probably going to raise rates at every single meeting this year. So barring some extraordinary switcheroo on Wednesday, he pretty much lived up to that.
And we thought that meant 25 basis points. If only we had known.
I didn't. I thought it was 28 basis points, but I was a little bit off here. We check in on the markets here on a daily basis here, and you are seeing some bids come in a little bit defensive here. The S&P and the NASDAQ, as well as the Dow and the Russell for that matter, just throw all four of them in there, each up about 1% here on the day. I do want to highlight real quickly, though, not on the board, is Dow Transports up 3% here on the day. So a little bit of a bid coming back into some of those cyclical names.
I'm so glad you mentioned that because that's not something you see when you look at the 11 industry groups in the S&P 500. Energy stocks and tech are on top, and tech on top for a change is kind of interesting given that when we have seen the market recover in the second half of this year, it's usually without the participation, the active participation of big tech stocks. On the downside, the only group that has not ticked into the green is consumer discretionary, and that's largely on the back of weakness in autos.
Yeah, and when I talk about sort of the defensive nature of this, a lot of healthcare stocks and energy stocks, those are your leaders. Cigna up 2% here on the day. That's another record high. In fact, Cigna, one of the best performing stocks in the S&P 500 this year. I actually went through, of the top 20 stocks, the best performing stocks in the S&P this year, 15 of them are energy stocks, and the other 5 are in the healthcare space.
That's telling.
Yeah, it is telling. We're going to get some earnings after the bell out of Oracle. Tesla down again, down 6% here, and keep an eye on Rivian. Those shares also down about 6% on the back of that decision to move on from that partnership with Mercedes. I do want to go back to the Fed here, guys, and we can flip it up here. I was taking a look at the equity risk premium, the idea that basically you take, the earnings yield over the bond yield, and you get a sense here of what investors are pricing into this market. Mike Wilson over at Morgan Stanley had a great note out today where basically he said CPI, Fed data, the Fed decision, that's all yesterday's news. He's actually looking ahead to what he sees as a contraction in EPS. And based on that, he's basically saying that the risk premium out there in the market right now is way too low. For those folks in the radio right now looking at a chart, we're still sitting at a risk premium that is basically at the lowest levels that we've had going back to the financial crisis. So back to 09, back to 2010 here. And that's cause for concern, because if we are headed towards an economic downturn or even a recession, that risk premium, at least in theory, should be a lot higher.
Well, speaking of a recession, everybody trying to figure out what happens in 2023. We just spoke to Carl Riccadonna a little earlier from BNP Paribas, and he does think that there is going to be a mild recession in the second quarter of the year. He's not alone. Earlier today, we heard from DoubleLine CEO Jeffrey Gundlach. He expects 2023 to be recessionary. Check out what he had to say a little earlier today.
The effects of these rate hikes and the accumulation of quantitative tightening and draining of liquidity from the bond market is going to make 2023, in my view, probably a recessionary year.
All right, 2023, a recessionary year. DoubleLine CEO Jeffrey Gundlach discussing markets in a virtual conversation with Zulauf Consulting CEO Felix Zulauf a little earlier today, Katie.
And the adjective that comes before recession is so important. If it's a mild recession, I've heard people say, that's good for credit. You can still have junk bonds even perform well in a mild recession. It's the depth and the severity of the recession where it has to get a little more nuanced when you think about what that means for markets.
But so far, it looks like based on positioning, investors seem to be anticipating a soft landing, a mild recession, given that people are positioning in some of those cyclicals like materials, like energy, like industrials.
Like industrials as well. I do sort of want to look ahead to this week, because we talk about the Fed. Obviously, we know the CPI data. You got 10 other central banks out there that are scheduled to announce rate decisions. And let's face it, a couple of those banks have already kind of signaled that this might be it, that this is kind of the end of their tightening cycle, at least for now, as they step back and reassess. No one's really expecting that language out of Powell, but maybe we get that language out of some of the other banks.
We do, but does it matter for Jay Powell? I don't think it does. I mean, we've done a lot of reporting over the last year about how, you know, the U.S. is not necessarily fighting this fight on its own to the extent that it's battling inflation, but it doesn't necessarily have the concern that it, you know, traditionally would have about other countries and the effects that it has on other countries if the dollar's strong, for example. Kate.
Whether the Fed is still the world central bank, I think, is going to be one of the most important questions next year. But at this point, at this week, it seems like all the big developed market central banks are still moving in lockstep. I think it's the Fed, it's the ECB, it's the Bank of England, all expected to downshift from 75 to 50 basis points. So still very much moving together.
You forgot a few there. You forgot the PBOC, Norway, Switzerland.
No, well, there's
Mexico.
11. I can't.
Do you
want me to name them all?
The Philippines, even Russia. What's Russia going to do?
Double-digit central bank announcements. All right. Well, looking ahead to 2023, though, I really do wonder to what extent the reopening of China will pose difficulties for the Fed as well, because we're not sure how that's all going to play out. It's looking like it'll be a lot messier than maybe people anticipated. You can't really trust the numbers that do come out of there in terms of infections, because the government's just trying to manage through everything, and it's a huge, I mean, you want to pivot, that's a pivot.
Yeah, well, that's a pivot. And look, I mean, China's in a whole different situation, too. I mean, obviously, they're dealing with deflationary issues. I think whether we can ignore them, is monetary policy the right role for that? Because I feel like so many of the issues that are in China that affect the U.S. economy are much more supply-side related and kind of outside the purview of monetary policy.
They are, but if you're a company that does business in China or gets components from China or even gets components from Taiwan, you absolutely can't ignore it. So, you know, unfortunately, for better or for worse, as a consumer, you know, we are still inextricably bound to China.
Everything made in America, which is why
that's hard to do.
Not even close.
Yeah, but in any case, to the point that these are supply-side issues, whether monetary policy can address that, it's the same thing. You can't ignore it, even though hiking interest rates isn't necessarily going to help.
Does Carol always get Mondays off? How does this work?
I'm just happy to be here.
Mondays and Fridays.
Yeah, this week, actually. That is the case. Hey, that does it for now. We are going to be back, though, for more of our cross-platform coverage in a little under an hour. Check us out on Bloomberg Quick Take, on YouTube, and, of course, on Bloomberg.com and Bloomberg TV. Then, of course, join us today at 4 for our Beyond the Bell coverage, where we take you through today's market close. This is Bloomberg.
It is Merger Monday. One of the big headlines there, of course, is what's going on with Amgen and their huge purchase of Horizon.
Joining us now, we've got Brian Scorney, Senior Biotech Analyst at Baird. He joins us this afternoon from New Orleans. Brian, how are you?
Hey, I'm doing great today. Thank you for having me on. Really a pleasure.
Yeah, thanks so much for joining us. So first of all, were you caught off guard? Were you surprised by this at all?
One of the nice things about Horizon being an Irish domiciled company, we sort of got a tip off that Amgen was one of the contenders here. Part of the regulatory requirements, or when a Irish domiciled company is potentially a target of an acquisition, they have to announce that. So a couple weeks ago, we got the heads up that Sanofi, Janssen, or J&J, and Amgen were all potential suitors here. They said it was very early stage. And I think, those of us covering Amgen have been watching it since that was announced. And over the weekend, we heard that Sanofi had bowed out due to valuation. We had heard earlier last week that J&J had bowed out. So, it was a pretty good bet that, today would be a merger Monday, as you say, with this announcement. So not totally surprised, but, I think there's reasons fundamentally why it is a little surprising for the size of this deal to be going through.
Well, you bring up valuation. Let's talk about the price tag a little bit. So Amgen, it arranged a $28.5 billion bridge credit facility to make this happen. All told, Amgen will pay $116.15 a share in cash. That's a premium of about 48% since Horizon Therapeutics disclosed on November 29th that it was in early talks with those three suitors. The price tag, is it too big? Does this make sense here?
Well, I think there's a lot to work through still. I think there's reasons to be concerned that it's a high price, but on the surface, it's not a terrible price. I mean, it's a company that's going to do around $3.5 billion in top line sales this year. They have several billion-dollar products that are growing nicely. Horizon themselves have sort of estimated peak sales at about $6.5 billion. So $28 billion for that is not, pushing the valuation beyond what we see in biotech. I think, you can calculate around an 8x sales multiple. I think there's a lot of questions, though, about, the financial stress they're taking on with the debt. Fitch and S&P have already come out, putting them on watch for debt downgrades. And they acknowledged this on the call today, saying they were hoping to get back to where their current investment grade is by 2025 by paying down this debt.
Right.
But it's certainly a big debt position right now for them.
Hey, Brian, what does this say about Amgen and how Amgen's thinking about its own product roadmap going forward?
Yeah, so it's interesting. Amgen had earlier this year a big investor event, and there's a lot of speculation or a lot of maybe criticism and skepticism when they sort of announced these very aggressive 2030 targets for revenue and EPS growth. They sort of laid out their case, but I think a lot of us, had concerns about how they could achieve those with what was in-house. And I think there was sort of this acknowledgement on the street that they were probably going to have to do deals to try to make these numbers up. And, Amgen didn't change guidance today. They basically kind of paused guidance and said they'll update guidance early next year when, the deal is going through. But I think, they certainly have some holes in their revenue growth towards the back end of this decade that needed to be filled. And I think to some extent this sort of is their effort to do that. And it does on a sort of EPS and revenue basis kind of fill in some of the declines that we expect from drugs like denosumab and Enbrel, which are multi-billion-dollar blockbusters for the company right now.
Hey, Brian, I'm looking over your notes that you sent over to our producer. You write that the competitive bidding process signals low ROI potential. Walk us through exactly what you mean by that.
Yeah, so right. I mean, I think what's nice about the deal and what is probably a good characteristic of the deal for Amgen is that it does look like it's reasonably accretive to the EPS, to the bottom line. The question is, are you just basically spending $28 billion to make $28 billion? Are you creating a positive ROI? And, I would say, I think all of us who've sort of studied M&A landscapes historically recognizes a lot of times these deals are not NPV positive. They may sort of fill in these gaps, but they don't necessarily create value for shareholders per se. And particularly when you see a deal that's aggressive as this went through, I think you wonder, okay, has Amgen to kind of secure the top bid, do they kind of really push valuation as much as is reasonably possible? So if you look at this, Sanofi started the bidding process. They made the initial bid, and they made 5 additional bids on top of it to try to get the company before Amgen, which had a number of bids of their own in the process, ultimately won out. And as I said, Sanofi sort of backed out over the weekend over valuation. valuation, Janssen, and there was another company who was brought over the wall to effectively say whether or not they wanted to be in on the bidding process in Janssen, and this company A declined to participate, seemingly due to valuation. So, that was my point there, that when you see such a bidding process, are you pushing valuation where maybe there's not an ROI?
So that's what's so interesting, Brian. I mean, if I were Rip Van Winkle and I had just spent, X number of years sleeping and woken up right now, I would have thought I woke up in 2021, not 2022, given the way that you're describing the M&A activity and the bidding for this. What does this say about the environment right now, at least when it comes to biotech? Because we are just not seeing this across the market today. Today's market activity, where we saw a lot of M&A, certainly notwithstanding.
Right. So, look, I mean, I think I don't think it's that shocking. I don't think it's that surprising. I mean, a lot of these large pharma companies have, slowing growth or LOE issues over the next decade. And, we've brought those up and flagged those as potential issues for Amgen, especially as you go out to like 25, 26. These pharma companies have big cash flows, and they certainly have debt capability to raise money. And we are in an environment where, we'll see what macro looks like. But certainly interest rates have been going up. And, I think companies want to take on debt while they can still get reasonable rates. So it's not surprising to see a tick up in M&A. And these things, they're not unseen. I mean, you have to go back and look a couple years ago to like the Gilead Immu deal, which was $21 billion, or the AstraZeneca Alexion deal, which I think is to the day 2 years ago, which was a $39 billion deal. So, these large pharma companies are still pretty aggressive about de-risked revenue generating opportunities where they see a place where they can really show accretive EPS and not risk the whole farm on something that's just entirely exploratory.
Well, on the topic of M&A, let's talk about the two other suitors here, Sanofi and also Johnson & Johnson. Could we see more M&A just as a function of these companies were looking to buy another company and they didn't here?
Yeah, so I mean, I think from the Sanofi perspective, that's a clear indication that they have a big balance sheet to play with, and they are certainly willing to be aggressive here. Right, they were an aggressive suitor to come in. They were aggressive with 5 bids. I would totally be looking in the space that Horizon is in, sort of this immunomodulation and inflammatory I&I space. As potential targets for Sanofi to now move, since they're not getting this, they're going to have to find something else. Janssen, Company B, they didn't put bids in. Janssen did, per the documents, they did due diligence on it. They did receive a full pitch deck from Horizon. They didn't put in a bid. So it's questionable how aggressive they really wanted to be, since the other two suitors didn't actually put in bids. It was sort of potentially opportunistic, but I wouldn't read too much into, Janssen is really, really aggressive.
Right.
I would read into Sanofi looking at this as a very, very aggressive company looking to do acquisitions.
We're speaking right now with Brian Skorney, Senior Biotech and Pharma Analyst at Baird. Hey, Brian, if we think about this in the context of, I hate to use this term because it's such a buzzword and it's, really a synonym for layoffs, the idea of synergies in this deal. What would you tell employees at these two companies right now, and how they should be thinking about that? Because that's really who synergies affect.
Sure. Well, it's really interesting because one of the questions a lot of people had on the Amgen call today was like, where are the synergies? How much is this sort of in line with what Amgen already does? And I don't know that there's a ton to cut here. And one of the points they brought up is the main program here, the lead commercial asset, this drug Tepezza, is an ophthalmology indication. And Amgen doesn't have an ophthalmology capability right now. So I would say for that product and that infrastructure, they're actually buying that infrastructure. So if I was a Tepezza commercial sales guy or in the R&D side, I'd be relatively comfortable. And Amgen even addressed it in that Amgen's looking to launch a biosimilar version of Eylea in the not too distant future. And I think this basically gives them that ophthalmology sales force and infrastructure to launch their biosimilar version of Eylea. So I think from that perspective, you're not going to see a ton of cut. Probably more on the rest of the systemic, more rheumatic disease space.
Okay.
There's certainly probably cuts to be made.
Brian Skorney, Senior Biotech and Pharma Analyst at Baird, talking all about that Amgen Horizon Therapeutics deal for about $27.8 billion. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We've got stocks holding at or near session highs right now. The Dow, the S&P, NASDAQ, all very much in the green. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. U.S. stocks with a bid from the start today, with the Dow currently up 427 points. S&P's gained 43, and NASDAQ is trading higher by 99. The U.S. 10-year yield at 3.62%. Gold is down 16. Oil is climbing, and Bitcoin is trading little changed. Among the main 11 S&P sectors, all were in the green, led by energy and tech. And leaders to the upside in the Dow, Boeing, Microsoft, and Visa, while Amgen led to the downside. In deal news, Weber to be taken private for $8.05 a share, and Thoma Bravo to take Copa Software private for $81 a share in cash. In other news, Kellogg is buying back $1.5 billion, and wrapping things up, Oracle reports after the bell. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
We thank you very much, Bill Maloney, and to hear live breaking news over your Bloomberg type Squawk, SQUA on your Bloomberg terminal. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Bloomberg Business Week is brought to you by SEI. Imagine your asset management firm's operational infrastructure as a competitive advantage. Let SEI show you how at SEIC.com/IMS. Well, Katie, it's like, is it getting old? Do I keep saying Merger Monday?
Happy
Is that
Media
okay?
Monday, am I right?
Merger Monday.
Merger Monday, that too.
Well, Thoma Bravo agreeing to acquire Coupa Software for an equity value of $6.2 billion. This after outbidding Vista Equity Partners. Joining us now is Bloomberg News Deals team leader, Leanna Baker. She's with us right now in the Bloomberg Interactive Brokers studios. Leanna, take us into this deal, and then I want to, kind of take a step back and talk about this environment, because as I said earlier, this is not very 2022 to have so much, M&A news break in one day.
And we were calling it Manic Monday, by the way, for how much activity
Is that an internal
there
term?
was. Yeah, Merger Monday is just a little overdone. But you wouldn't expect that in a year that's been really in the doldrums for deal making to see, massive deals like this. Coupa's pretty big take private for Thoma Bravo. And there was actually a bidding war. We had reported right before Thanksgiving that Vista Equity, which is sort of a rival of Thoma Bravo, was bidding.
Right, very big into the software space.
Both are very big into software, and they've kind of perfected these deals where they take companies private and they don't use traditional financing like banks. They get private credit. So a lot of big names, were backing both bids, and it was really down to the wire over the weekend, and we were lucky to call it for Thoma Bravo.
So this is their playbook that they're establishing, at least for this year, sort of take private deals for Thoma Bravo.
And it's especially companies that have seen their shares sell off massively. So Coupa, 2 years ago was trading like above $300 a share, and it goes private for $81 a share. What we'll be looking at is whether shareholders are satisfied with this deal. We already have heard some rumblings of shareholders in Coupa who are looking for a price of higher than $81 a share. A few weeks ago, we had a story saying one shareholder wanted $95 a share, for example.
I mean, everyone always wants more money, though, right? This is a 77% premium to the closing price on November 22nd.
Before our story.
So that's pretty high.
It is, but you never know with shareholders and activism, which has become, a big story in corporate America. But we'll see. The shareholders have been quiet today. We haven't seen any dissent today, just a few letters, over the past few weeks.
And so I know Thoma Bravo. I don't know Coupa as well. What are they getting out of this M&A?
So in 2016, they IPO'd. It was the same CEO, Rob Barstein. I helped cover the IPO back in the day. And they do spend management software, so they compete with, like, SAP would be a big player. So that was a company we were looking at whether they would take a look at it, for example. But yeah, they're in the spend management space, and they help with corporate expenses. Keeping that under control is something that is a theme out there with big companies. So they're sort of in the a sweet spot, if you will.
Okay, then Thoma Bravo, let's say this goes through. Given what we know about what the private equity firm has done in the past to different types of investments that it's made, different types of purchases that it's made, What do they end up doing to the company, and what's sort of the ROI on it? What do they do, in a few years?
We'll be watching to see whether they merge it with, current portfolio companies. They bought a company called Anaplan, which does something similar.
That was pretty recent, right?
Right. So they've really been on a spree. At this point, we don't have the reporting to say they're going to merge all these companies together. They've bought a lot of companies in the cybersecurity space. They don't always merge those together, for example. So we'll see what happens. But for now, they'll be looking to get this deal closed without having to raise the price for, in case there's any shareholders dissent. And then we'll see. I'm sure they'd love to IPO it when the IPO market comes back one day in the future.
One day. Wait, you're not making a prediction.
Yeah.
Well, I mean, it's interesting, again, thinking about Thoma Bravo's playbook here, take private deals, to your point that they're basically bargain shopping in these deals. There's a lot of bargains out there. If you think about the wreckage that we've seen over the past year and some of the share prices, with that in mind, what does 2023 look like? Are there some other brave souls out there looking to bargain hunt?
For sure. I think Thoma Bravo's competitors like Vista, which I mentioned, which was competing for this, and others, they're looking at, their Bloomberg screen and they're seeing what's trading not well, but it's sort of the same old targets, which I don't want to get into, what's the next stock to buy because it'll be acquired. We're trying to figure that out ourselves.
Yeah.
But I think the enterprise software space is ripe for more of these potential take privates for sure.
What do you mean by that, though? I'm not going to ask you to name again, because you're trying to figure that out. And by the way, if any of you have any tips for Leanna and her team, you know how to reach her. But how would you generalize that? Because when you think about covering this space, you think about it from the perspective of, okay, the environment, is it a certain way? But it's different for different types of industries, different sectors here.
Earlier this year, Zendesk went private, which is in a similar space. So that got us thinking about what are the next ones on the horizon. And deals always beget deals. So definitely Coupa's competitors could be looking at, potentially doing deals, and we're trying to track what are those underperforming kind of SaaS stocks that, private equity could be licking their chops at.
And so can we talk about IPOs a little bit? Let's go there because
What IPOs?
I know. When does that change? It feels like the pipeline has been totally dry, or if there's people in the pipeline, they're just not coming out. How long can this drought last?
It's a great question. I think candidates are looking now at the back half of 2023, which is never a good sign when, you're going into a new year. But the window will open, in January, and we'll see. But I think companies want to know that things are going to be more stable in the macro environment, and that, it's all about timing, and you don't want to miss time an IPO. It could be pretty deadly.
Okay, I'm going to do something a little crazy here, Leanna, okay? I'm going to tie together what you do on the deals team with what we hear from Fed Chair Jay Powell later this week, because that's certainly one thing along with CPI that we're all watching tomorrow. What do you look for as a deals reporter to hear from him in terms of financial conditions? What do people who are in this space look to hear from him as to whether or not the environment will change in 23?
So it's all about CEO confidence and what CEOs want to hear, and they want stability. They don't want to worry about, inflation and raising prices. And, things have to be stable for boards to be comfortable to transact either as buyers or sellers. So I think, stability is the main thing we're looking for. And that's what will hopefully, lead to more M&A next year.
Go ahead, Katie. Did you have a question on CPI?
No, on CPI specifically?
Yeah.
No.
Oh, sorry.
Yeah.
All right. That's fine. Okay, so Leanna, when we think about other deals, I don't give away anything that your team is working on, of course, but the broader environment of the day today. You say it's Manic Monday. Is that like, I don't know. I don't want to go back to using the term that I used in our previous interview when we were talking about the Horizon and the Amgen deal. But how rare is it to see sort of in 2022 a Monday like this?
So there's only one more merger Monday of the year because the market's going to be closed the day after Christmas. So if you want to get your deal done this year, that's why you're seeing kind of this final burst of activity. There was another deal today, Microsoft buying a stake in
we barely
LSE.
talked about that.
That was fascinating. It just shows you, even if deal making's in the doldrums, tech and healthcare, those sectors are always going to be a bright spot. There's just so much growth there and, interest.
Well, my next question was going to be, why is that a bright spot? Because the concern about tech right now more broadly is that we're not seeing as much growth as we were seeing in previous years.
Right, and that's where, you see a dislocation in stocks and where private equity could come in. So, lack of growth in tech could lead to more deals. It's just, in the deal-making world, tech and healthcare are usually the busiest sectors, and that continues to be true.
Okay, no exception today. Leanna Baker, Deals team leader, joining us right here in the Bloomberg Interactive Brokers studio. Okay, Katie, I know you do really want to talk about CPI here.
I do want to talk about CPI because there was a really interesting read spike on the terminal, the headline of which is JP Morgan's trading desk sees the S&P 500 rallying up to 10% if we get soft CPI tomorrow. Really interesting probabilities they put out here. So 6.9% or lower on the headline year-over-year print. That is a 5% probability. But if it happens, they see the S&P 500 reacting with an 8 to 10% rally.
Hold on. This is like too many numbers to make my head is spinning right now.
Should I talk slower?
No, I hold on. So, okay, the most likely scenario, that's like an outlying scenario, right?
Yes.
There's a minimal chance.
There's a 5% chance.
There's a 5% chance that the S&P 500 rallies up to 10% tomorrow.
No, there's a 5% chance that CPI comes in at 6.9% or lower.
Okay, thank you.
The headline, or the expectation rather, is 7.3%. So anything below a 7% handle would obviously get stocks reaction.
What do you think is going to happen?
I don't have any ideas. I'm just a journalist.
Remember what happened last month?
Huge rally, 3.3%.
Yeah. All right, we'll see if that happens again. All right, you're listening to Bloomberg Business Week. Tim Stenevec and Katie Greifeld. Let's go to World and National News. Nancy Lyons is in our D.C. newsroom. Hey, Nance.
Thanks, Tim. The U.S. economy does remain strong with inflation weakening and consumer spending still high. This as the Federal Reserve meets again this week to decide on slowing the pace of interest rate increases. Bloomberg's Irv Chapman has more from Washington.
The current pace of consumer spending will be slowing down, Lindsay Piegza, chief economist of the firm Stifel, said in a Bloomberg interview.
We continue to see elevated prices, negative income growth, negative manufacturing activity, a housing market under extreme pressure, increasingly weigh on the consumer. Even for the labor market, we're starting to see signs of emerging weakness.
The Federal Reserve is seeking to slow the economy as it fights inflation, Piegza said, and that will be happening. In Washington, Irv Chapman, Bloomberg Radio.
Sam Bankman-Fried, the founder and former CEO of now bankrupt crypto exchange FTX, says he will testify remotely before tomorrow's House Financial Services Committee hearing. Democratic Congressman Brad Sherman, who serves on that committee, tells Bloomberg the collapse of FTX is the final straw for him.
It's time to prohibit Americans from investing in crypto. If we can't do that, if we're able to impose the Know Your Customer and anti-money laundering statutes on the entire American-involved crypto ecosystem, then you'll strip away from crypto the one reason it has for existing, and that is to be a hidden currency.
Sherman says the U.S. does not need a product that was purposefully set up to evade U.S. law. The Supreme Court is expanding its planned showdown over President Biden's student loan relief plan. Justices will now consider arguments from two borrowers who contend they are being unfairly excluded from the program. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We've got stocks once again at the best level of the day. Just about 20 minutes to go ahead of the closing bell with the Dow, the S&P, NASDAQ all advancing. S&P now up by 1.3%. Tech-heavy NASDAQ 100 index also rallying up by 1%. The Dow now higher by 506 points, up 1.5%. NASDAQ is up 120 points now. That is a gain of 1.1%. The 10-year yield 3.61%, with the 2-year yielding 4.39%. Gold down 1%, 17.80 the ounce, while West Texas Intermediate crude is up 3.4%, 73.41 a barrel. With just about 3 weeks to go before the new trading year, portfolio manager Julie Beal at Kane Anderson Rudnick does see a slowdown ahead.
Looking forward into 2023, there's not a lot to be that enthusiastic about. And so my thought is that I think the weaker consumer confidence leads to weaker business confidence, and that leads to lower investment, the decisions to start trimming employment, particularly on things that we got very bulked up on, so things in marketing and technology spend. I think those are going to get soft, and that's going to cascade through the economy.
Rivian Automotive is shelving plans to jointly build electric vans in Europe with Mercedes-Benz, aborting a deal signed just 3 months ago to share costs and technology. Rivian Automotive shares are now lower by 5.9%. Recapping a rally underway ahead of the CPI report tomorrow and, of course, the Fed decision on Wednesday. S&P up 50 now, a gain of 1.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive.
Just drive, baby.
It's the question that drives us.
This is the drive to the close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
What's the saying? Don't blink or you'll miss it. That's the rally that's happening right now. We're seeing some buying into the close. We got about 17 minutes to go to the end of equity trading. Right now, the S&P 500 higher by more than 1.2%. 3982 is the number there. The NASDAQ composite at 11111. How's that, Katie?
I'm glad you got that in there. I was just wondering what the exact number was.
Well, that's what it is. I had some listeners and viewers get in touch and ask me to do numbers specifically.
Really?
Yeah. So that's for them.
Was it like your dad?
No, it wasn't my dad. He likes the percentages. Up close to 1% right now. What is Jake Jolly like? We're going to get into that in just a minute. He's senior investment strategist at BNY Mellon Investment Bank. He's with us right now in the Bloomberg Interactive Broker Studio. Jake, it's really good to see you. How are you?
It's great to be back. How are you?
I'm doing well, thanks. So how about that rally?
I'm not going to complain.
Rallying into CPI tomorrow. It's not like oftentimes when we have a week like this, the narrative is like, okay, everybody's just kind of waiting to see what CPI is, waiting to see what Fed Chair Jay Powell says. What's going on today?
Well, not a lot. So I think we need to be a little careful, a little cautious. We've certainly had times this year where the setup has been very strong into inflation reports, and we've been disappointed and seen pretty strong negative price reaction. Of course, coming into this one, the last inflation report we got that, more than 5% pop in the S&P 500. So, I think we all are hoping for that, but we'll see what the numbers give us tomorrow.
So since July of last year, all the CPI prints we've gotten since then, or maybe not all of them, but the trend line is clear. When you get softer than expected CPI, the S&P 500 rallies. It's the exact opposite dynamic. I'm not going to ask you to guess what happens tomorrow. I do want to talk about next year, though, because there's a line in your notes that caught my attention. It's quite possible for bonds to rally next year as equity comes under pressure. I've heard something similar from around Wall Street, that it's going to be a great year for bonds, maybe not as much for stocks. I want you to explain it to me.
Yeah, definitely. So when we look ahead, all of the forward-leading indicators suggest that the economy is slowing down, right? We're still in this situation where the labor market is too tight. Wages are growing at a rate that is inconsistent with getting inflation back down to target. So we think that the Fed is going to have to keep rates higher for longer. That means that the economy is going to slow. And really, when we think about which asset classes we think are going to perform well next year, those growth-sensitive equities are likely to come under pressure. So we still see some downside risk there. Whereas when we look at bonds, we're at much higher yields now. So you really have to think about the price return on the bonds as well as the income return. And because the yields are so much higher now, you really have a pretty large cushion. So in terms of your total return in your bond portfolio, you have sort of that built-in security of even if rates continue higher, I'm still looking at a pretty attractive total return. And just historically, what we've seen through periods of slowdowns, particularly during recessions, is that bonds really kind of shine and outperform equities.
And when we talk about bonds, let's get specific here, because are you talking treasuries? Are you talking credit? If you're talking credit within credit, what are we talking about?
Yeah, I mean, historically, sovereign bonds, so U.S. Treasuries have been sort of the best performers early in the recession. Higher quality credit is definitely sort of the safer place to be, just because, as we know, if we go down the credit spectrum into sort of more higher yield, that's typically where we see bigger spread widening. So that's certainly potential headwind. But all in all, we are still looking at yields that are so much higher that we think that sort of taking on that spread risk is worth it at this point.
Do you have any more questions about bonds,
I
Katie?
do, actually.
Okay, go ahead.
But no, if you want to ask
No, this is your vibe. Go ahead.
I know, but it's your show.
That's okay. No, it's our show.
Okay, well, the question that I was going to ask is, there was a really interesting note from Bank of America out last week talking about credit spreads, because you look at what's happening in equities, still in this rolling bear market. You look at what's happening in treasuries. It seems like we're pricing a recession there. Then you look at credit spreads, remarkably unruffled. To Bank of America, that's a potential warning sign. What do you read into that, though, that the credit market has been so calm?
Yeah, I mean, I think it's certainly a sign that we are not fully priced for a recession. Even though we've had inverted yield curves for a number of months, and certainly more parts of the yield curve have inverted of late. When we look at yields, they've been relatively muted. I mean, they've certainly increased, right? That's been the trend this year. But we have not seen sort of the spike above sort of those thresholds that historically have been associated with recessions. So that's one area that we are looking to as a forward-leading indicator to suggest that, yes, the recession is taking firmer shape in 2023.
What else tells you that a recession is taking shape in 23? And how deep of a recession is it going to be, in your opinion?
Well, you can look at sentiment, which has been pretty poor for a while. You can also look at positioning. And I think on both of those measures, what we're seeing is that there is a lot of pessimism out there, but we just haven't seen sort of that throw your hands up, give up type of situation that is typically
run away screaming.
Yeah, exactly. And I mean, the way I think about it is that typically that process of kind of developing a trough, you see it in a recession. And I think so far this year, we've had a ton of volatility around expectations for Fed funds rates, which have really been very volatile. I mean, if you look at interest rate volatility, it's been very, very high at the same time that equity vol has actually been very, very low of late. So, we look at those and we think, next year, those signals are probably going to start flashing, and it will be more obvious that the time is to re-risk. We just don't think it's right now.
Yeah, one of the greatest mysteries of this year's markets has to be the big divergence in equity and bond volatility. But I want to talk about equities in a recession. We only have about 30 seconds here, but obviously I could see how that would be good for bonds. But in the equity landscape, is there anywhere that you can go on offense in a recession?
Well, you definitely have to pick your spots, right? I think our view on it is that in a recession, the parts of the equity market that are going to perform the best are going to be those that have greater exposure to the quality factor. So quality is a pretty loosely defined term. It means different things to different people, but I think at the core of it, it is really about profitability. So those companies that have stronger balance sheets, less leverage, really have business models that are more likely to hold up and not be called into question when, growth becomes scarce,
right.
Those are the companies that tend to make it to the other side, or at least not get beat up quite as much in a recession.
Jake Jolly, Senior Investment Strategist at BNY Mellon Investment Management. We love it when you join us in the Bloomberg Interactive Brokers studios. Thanks so much for joining us. This is Bloomberg.
These are some of the stories we're following for you. It is now just about 3:53 on Wall Street. Stocks are pushing higher. Goldman Sachs aims to cut at least 100 more jobs as the Wall Street Titan restructures its struggling consumer business and braces for an uncertain economy in the year ahead. Now, sources tell Bloomberg the bank is drafting plans that could eliminate at least 400 positions from its loss-making retail banking operations. CEO David Solomon has said he is dialing back the firm's ambitious goals for consumer banking. Goldman Sachs shares are up right now by just about 1.1%. New York Attorney General Letitia James has announced two multi-state settlements totaling $10.7 billion with CVS and Walgreens for the pharmacy's role in the opioid crisis. According to a statement from her office, CVS will pay $5 billion, Walgreens will pay $5.7 billion. A major deal as Amgen agrees to buy Horizon Therapeutics for about $27 $4.8 billion in its biggest ever acquisition, outlasting at least 2 other suitors for the developer of autoimmune disease treatments. Today, shares of Amgen are down by 1%. Horizon shares surging now by 15.3%. And Thoma Bravo's agreed to acquire Coupa Software for an equity value of about $6.2 billion after outbidding Vista Equity Partners. Those are our top company stories. This is Bloomberg.
You're listening to Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
It's Bloomberg Business Week. Tim Stenovic and Katie Greifeld. We're live in the Bloomberg Interactive Brokers studio. Katie in for Carol Masser this afternoon. Katie, we got a couple minutes till the markets close. Have you been spending much time on Twitter lately?
Yeah, I spend every second of the day on Twitter. These 2 stories, though, I hadn't been following, so I'm excited to talk about them. Do you want to start with Michael Burry?
Yeah, let's start with Michael Burry. He's got such a strong following among investors that traders picked his Twitter handle as the best, even after he once again deleted it. So almost a third of the 515 respondents in the latest MLive Pulse survey last week voted for Michael J. Burry as the best investor handle, with his popularity especially high among professional market participants.
I sometimes forget that it's Michael Burry that I'm following when I see him tweet, because
it's what, Cassandra
BC, and I'm like, oh, who's Cassandra? Why do I follow her? Other options that respondents could vote for are Jeffrey Gundlach. He is at Truth Gundlach. Bill Ackman, he's just at Bill Ackman, and Kathy Wood, she is at Kathy D. Wood. But it was Michael Burry who won out, and I have to say he is a fun follow when his account is active, when he hasn't deactivated
and
it.
he deletes tweets a lot too after he
Yeah,
sends them.
he does. So you have to screenshot if it's something really good.
Vanishing Twitter mode. Why wasn't your handle on this?
You know, it's so weird. I'm going to say it's because I'm not an investor, actually.
Okay.
I am just a journalist, though. I do tweet a lot, and I follow all of these people. Truth Gundlach is pretty fun as well, but it was Michael Burry who won out.
I am taking a Twitter break, not for any personal or health reasons, but I haven't seen the final episode of White Lotus.
Isn't
and I know
that good?
I just don't want it to be spoiled for me.
I was
okay.
that way
It's
with
not
Game
as good
of
as the
Thrones,
first season.
actually.
Yeah, it's annoying that people tweet about this stuff,
What
but I know
I
as soon as I
did-
log in, I'm going to see something. The same thing happened with
I
me in
just
Succession.
muted words.
Yeah, but it's like
and I
so many
blocked
words you have to
accounts.
mute. I have to go back and figure out what all these characters are
Lotus,
named.
White,
No, all these characters and like
Beach.
their pictures that people are posting. It's ridiculous. People,
Yeah.
you don't have to tweet about every show you watch, okay?
Would you be tweeting about it?
No,
though?
I
Have
don't
you
tweet
watched
about
it?
the shows.
Yeah.
I just want to look at Twitter.
That's
hey,
why it's nice to watch The Crown.
speaking of
because
Twitter-
It all happened. Yeah, tell me.
Okay, Elon Musk, the CEO and owner of Twitter, was booed on stage for several minutes at a comedy show in San Francisco on Sunday after spending the weekend attacking former Twitter employees and outgoing top U.S. medical advisor Anthony Fauci.
There you go. Yeah. It was a dark place on Twitter this weekend. It seemed
Yeah.
like the vibes were off.
All right, well, coming up next, we're joined by our friends at Bloomberg TV for our Beyond the Bell segment. You're listening to Bloomberg Business Week and watching it on Quick Take.
Connection lost.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu. We're counting you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast. Tim Stenovic is here. Katie Greifeld is here. Carol Masser, nowhere to be found. We welcome our audiences across Bloomberg Television, radio, as well as on Quick Take and YouTube. Tim, a pretty interesting day here. I mean, I don't know how much you could read into the price action, but stocks are significantly higher here on the day, about 1% across the board.
Yeah, we just posed that question to Jake Jolly over at BNY Mellon Investment Management. He's senior investment strategist there, and I said, "Hey, what about this rally?" He's like, "Yeah, I just saw that. He was in our studio right here." He couldn't explain what's going on, but what he did say is be a little cautious ahead of those CPI numbers. And although we got a softer than expected number last month that ended up causing a surge in U.S. equities, he reminded us that we've been disappointed in the past.
The biggest post-CPI surge ever.
Right, but he said he reminded us that we've been disappointed in the past ahead of CPI. So proceed with caution.
And I will say it is interesting that if you look at what volume is doing, we had been trending lower on volume throughout the day, but with this late surge, we're looking at 1.4% on the S&P 500 right now. Actually, volume is just a hair higher than its 20-day average. So this is coming on some actual healthy buying here.
Some healthy buying, yeah, which surprised me because there's so much going on this week. It feels like once we get past CPI, once we get past the Fed, is everyone just done for the year?
Yeah.
I mean, you know,
The last week that matters.
I'm taking off on starting Thursday.
But Romaine, you are going to be back with us before the end of the year.
Oh, I am?
Yeah, just reminding you, you're not going on vacation for the rest of the year.
Can we still
That's
do
not
that?
allowed.
I'm sorry.
Okay. All right. Well, we're going to find out. I think really, I mean, in all seriousness, I think the next 36, 48 hours really going to be pivotal for this market. And I think to Scarlett's point, going to be pivotal to determine whether anybody actually decides to trade post-Fed here. At least on this day here, Dow Jones Industrial Average higher by about 1.6%. The S&P higher by 1.4%, while the NASDAQ higher by about 1.2%. I do want to point out the Russell 2000 is closing higher by about 1.2% as well. And Dow Transports actually rallied 3% here on the day. And I do want to point out they actually did reclaim that 200-day moving average. So if you are looking at those technical levels, a lot of technical levels that I think will be back in play over the course of this week. At least one of the major averages back above that 200-day.
Well, speaking of technicals, let's talk a little bit about breadth in terms of gainers and decliners today in the S&P 500, Scarlett. We only saw 33 stocks move lower in the S&P, 467 move higher. Romaine's going to get angry when I mention the Dow, but we got to point it out that only one stock, in fact, lower on the Dow and 29 are higher. Weighted, or yeah, we still price weighted. Okay, so yeah, you're still important to me, Dow.
We can't ignore the Dow, but of course we can't really look to the Dow to give us any read into what's going on within the market. So let's go to the S&P 500 and the 24 industry groups there, and you could see pretty much a green day all across the board. The laggard here are auto stocks, off by 4.5%. The best performers, transportation, as Romaine mentioned. You definitely see some positioning into cyclicals, like the industrials, like the energy stocks, like the material stocks, which show that people are looking ahead, certainly to a Fed pause and eventual pivot. You like how I added that word, eventual, Katie?
Eventual, no, that's an important qualification. Before we get to CPI and the Fed, we did have a very robust M&A Monday, merger Monday, whatever you want to call it. In any case, Thoma Bravo, obviously we all know this story by now. It's buying Coupa in a $6.2 billion deal. You look at what that meant for Coupa shares, just absolutely skyrocketing up 27%. Going down the list, we have Amgen buying Horizon Therapeutics. The company arranged a $28.5 billion bridge credit facility to do that. So pretty big price tag there. You look at what that meant for Horizon, up 15.5% or so. And finally, we do have Weber. Those shares rose over 23%. That's after news that they entered a take-private deal with BDT Capital Partners. That deal values Weber on an equity basis at about $2.3 billion.
All right, let's talk about decliners. Kind of tough to find some notable decliners today. You did mention Horizon Pharma, so I should mention that Amgen did close down about 0.7%. Let's talk Tesla, though. Shares finishing the day down by 6.3%, to it closing at its lowest level since November of 2020. No specific news, at least today, dragging the company lower. But I do wonder to what extent Elon's tweets and concerns about the fact that he's so focused on Twitter are weighing on sentiment at the company. We had a great story by Sean O'Kane last week about what one large individual shareholder said about the board being MIA. Moderna shares down close to 7%, finishing down 6.9% today. Again, can't quite figure out why. Pfizer did come out with earlier in the day saying that mRNA vaccines could give them up to $15 billion in commercial potential by 2030. But that happened midday, and Moderna shares were under pressure before then. And then Netflix shares. Think back to last week when Carol was talking about this day after day after the stock kept moving higher. It's up nearly 90% since those May lows. A little bit lower today, down 1.5%, Romaine.
All right, a quick look here at what's going on in the yield space, pretty much higher across the curve, about 3 to 4 basis points right now on the 2-year yield. We should point out we had an interesting auction a little bit earlier today on that 10-year yield and on that 10-year, and it was not good. Basically, the demand just wasn't quite there here. It'll be interesting to see whether that was just an anomaly, given that, of course, it was priced right before a big CPI report and a big Fed report. We get a 30-year auction tomorrow. But overall, we go back to sort of that inversion that we've seen on the yield curve, an inversion that remains. And that really is kind of the story, because this is sort of the look ahead, I think, beyond these rate hikes, beyond peak inflation, what's on the other side. And if it is a recession, and that's what the bond market is pricing in, then I think equities have some repricing that they have to do as well.
But there's always been this split between what equities see and what bonds see. I wonder, when it comes to inflation, how much the New York Fed survey on household inflation expectations really set the tone for today going into CPI. The New York Fed survey showed that people are expecting lower inflation, still inflation, but lower than perhaps what they had projected last time. My question is, how reliable are these household surveys? If someone called you up, Katie, to ask you what you thought inflation would be, would you be able to quantify it?
You know, I don't think I would answer the phone, to be honest. So that would be, it is.
That's a real issue with these surveys.
I know, it is kind of fun to think about.
And who answers them? That's
the
a real
methodology.
issue.
But if you think about the survey-based measure, you think about the market-based measures of inflation expectations. If you look at break-evens, they've all been contained. They've been out of step with the actual data for a while.
And I just want to point out, too, I mean, even if you get away from the consumer, I was looking at the Philadelphia survey of professional forecasters, so, you know, not just people sitting at home on their couch. And their actual expectations going forward are actually in that 2% range, and they're looking primarily at the PCE data.
2%
so
when?
over a longer term period, so over 5 to 10 years, which is exactly what the Fed wants to see. They want to see those inflation expectations anchored around that 2% level, and they are, and they have been. And I think that if there's any silver lining here, at least for the Fed and what it's trying to do, that maybe might be it.
Well, to go back to Scarlett's question, I think every little bit of information that we get helps inform the trend line here, right? So it goes back to what we got last week with University of Michigan, Scarlett, and the idea that inflation expectations, at least in the short term, came down significantly. So it's every little bit of data, I think, that investors are weighing here. But again, you know, it's kind of the most important thing happens on Wednesday when we hear from Fed Chair Jay Powell.
Well, every little piece of data is what people are focused on. We do have data out of Oracle. Second quarter revenue of $12.28 billion, higher than what analysts had been looking for. The consensus estimate was just over $12 billion. Adjusted EPS also coming in better than expected by 3 cents, $1.21 for the adjusted EPS. Right now, the stock is up about 3% at the moment.
Yeah, and this wasn't really that unexpected. I think the fact that they continue and the idea that business spending has generally held up, particularly for some of these legacy software companies and database companies like Oracle, a good thing. We should point out margins coming in a little bit light here, so a little bit of a squeeze there. And I think that has been a concern going forward, that these companies might still be able to post growth, but whether that margin story that sort of carried these stocks over the last couple of years is going to be there remains in question.
And you see Oracle shares up about 3% post-market, jumping around a lot, but it seems like the trend is higher. The question on margins is a big one. Obviously, you've had a lot of big bears on Wall Street calling for sort of peak margins, that you're going to see that story deteriorate a bit next year, maybe as companies reach peak pricing power.
Everything this year was peak, right?
It was peak. I hope so.
The trough.
Is it though, or
Well,
does it stay there for a while?
Well, to that point, Jake Jolly just a few minutes ago said that we're not seeing a trough, Scarlett, when it comes to equities that's consistent with what we'd see in a recession.
Can I just point out, though, I mean, CPI is supposed year over year still coming in at 7.3%. At least that's the consensus estimate. 7%.
That's hot.
Well, yeah. Why am I supposed to be?
But because it's the trend. It's coming down. It potentially peaked, and that means that you know
one or whatever.
What does the
and then maybe, but also base
last
effects.
time I checked, they had a 2% or 2-ish, right? They sort of changed it, right? A sort of broader target, but we're nowhere near that.
If you think about a Fed that is very, very cautious about over-tightening, they don't want to do that. They're paying attention to that trend because it's 7% now, but how quickly it drops to 2%, who really knows?
Exactly. I mean, just because it went up a certain way doesn't mean that the way down mirrors that or is symmetrical in any way. And we haven't really figured out that part of it yet because we haven't seen inflation in so long.
All right.
Well,
All right.
I'm going to cut back spending already to do my part here.
Thank you.
Right ahead of the holidays.
I'm going to keep stimulating the economy.
Right ahead of the holidays. All right. I'll remember that when I don't get a gift from you, Romaine. That is going to do it for our cross-platform coverage. At least for now. It's the market close on Bloomberg Television, on radio, on YouTube, and of course on Bloomberg Business Week. We're going to be back tomorrow, same time and same place.
Actually during the weekend, but you know, I just wasn't. It's early. It's earlier than we would like to.
You're not showing up. Yeah, you're not showing up that
Yeah.
day and actually getting a reservation.
It's at like 4:44 p.m. or it's at 10 p.m.
You're gonna. Okay. Well, if it's at 4:44, you should still be at work.
For sure, definitely.
Okay.
And I will be. So obviously we took the 10 p.m. reservation.
Okay, there it is. Let's get into the health of the restaurant industry. We're really pleased to have back with us Debbie Su. She's CEO of Open Table. She joins us once again via Zoom from San Francisco. Debbie, good to have you back with us. Katie and I got to speak with you just a few months ago. How are you?
I'm doing well, and I'm so happy to be here with you all again.
Well, it's good to have you back with us. Last time we spoke, you talked about the idea that consumers were diners were returning to the platform in droves. What's changed in just a few months? Give us a health check of the restaurant industry.
We are continuing to see that dining demand remains really strong. If you look at the year end, so for this entire year, we are approaching nationwide pre-pandemic levels. We're up versus last year. So we can say that dining is back or that dining has held strong. The holiday season is looking great. Thanksgiving is usually a good, a sign of what things are to come during the holiday season. And demand was really strong then. So we're just seeing that people are continuing to prioritize that dining out at a restaurant experience, despite all the news we're hearing and we're feeling it as well, right?
Mm-hmm.
About inflation, rising costs, all that economic turbulence. People are continuing to, allocate pieces of their household P&L to the dining out experience.
How do you explain that? Because those things are at odds.
Yeah, I know. And I think, we're still seeing some pent-up revenge dining, I think, as a result of the pandemic, when many of us were cooped up in our houses or apartments for a long time. So I think that is still playing here. I also think it's because for many of us, the nature of work has changed. Many people work remotely. Some people are in a hybrid situation where they go into the office twice a week as opposed to 5 times a week. And I think people are really craving that in-person, experience that they're not getting when they're just working from home.
Mm-hmm.
And so I think, dining out at a restaurant is one of those ways they can get that. And we're seeing that in the data too. We're seeing, for example, pre-pandemic days, bar seating was the least favorable type of seat that one could book. And right now we're seeing people are actually requesting those seats and wanting to be in the thick of it all.
No kidding.
So I think because work is changing for many of us, that has trickle down effects, into dining and our behavior as consumers, what it means now to go out to a restaurant.
Debbie, let's unpack some of those trends. If the shifting nature of work is changing how people are dining out, what does that mean in terms of what days that people are coming to restaurants, what times, things of those natures?
Yes, so we're seeing that Mondays, to your point, are, so historically Mondays were a very slow time for restaurants pre-pandemic. Right now, what we're seeing, Mondays are the weekend after party. It's kind of an extension of the weekend. So we're seeing really big increases in dining compared to last year, up 27% on Mondays. The time is also different in terms of the time that people are going to reservations. You had said 4:45 or 10. We're actually seeing a lot of people dining between 4 and 5. That time period increased 27%, a very large increase compared to pre-pandemic time. So happy hour is the new dinner.
Why do you think that is?
I think it's because oftentimes, like if you are working remotely or hybrid, you don't have a commute time, right?
Oh, that's a good point. So
you could be done with work and you can shut down, your computer and just literally, leave your home and go to a restaurant.
Debbie, does that change? So I've talked about this a bit. I don't have any data on this, and I'm hoping you can help with this because it's all anecdotal for me. But in my neighborhood in Brooklyn, I come into work every day because I can't work remotely. But if I'm off a day and I'm at home and I'm walking around the neighborhood, it is like packed. Sandwich shops that are usually packed on a weekday, on a weekend only, are packed during the week because people are working from home. Do you have any data that shows sort of the epicenter of these areas is kind of shifting a little bit because of people's work patterns?
Yeah, so the Brooklyn story or your experience is very similar to what we're seeing. During the pandemic, I think a lot of people moved out of the city proper and in areas around a big city. Brooklyn here could be an example of that. And so we're seeing a lot of dining activity happening, in Brooklyn versus, in the middle of Midtown or Manhattan. We're seeing that in the Bay Area here in San Francisco. So we're seeing like emergence of kind of these areas outside of cities really gain in prominence. And I think Brooklyn also, like it tends to have a younger demographic. If I were to guess, like a very cool demographic. So
I'd like.
Tim's pretty young.
I don't know if I'm either of those things, but thank you, Debbie.
Young and cool.
Thank you. I appreciate that.
It's not surprising to hear that we have, there's a big remote workforce out there that, during lunchtime can go to the sandwich shop down the street.
So I've been thinking about what you said about people actually, in some cases, requesting to sit at the bar, because I've never done that in my life. But I don't want to sit at the bar. I don't want to sit next to people.
Okay.
That's what I mean.
Okay,
but in any case, are you seeing that in that sort of drive to be in the thick of it, in the action? Are you seeing that in the dining choices that people are making in terms of the types of restaurants that they're booking?
Absolutely. So we're seeing diners really crave that connectivity. So cuisines like Korean barbecue, hibachi grill, Brazilian steakhouse, those types of food venues are doing very, very well. Because again, unlike you, a lot of people want to be in the thick of it. They want to be sharing a table with folks they don't know and being in that kind of communal environment.
That's so interesting. Does this hold?
We're seeing it hold. It started up last year and it's continued to persist this year. I really think a lot of it is related to the pandemic and kind of a new post-pandemic life with, again, work changing for so many of us. Mm-hmm. That, right, like it impacts other facets of our life.
And so, I mean, if theoretically we're here a year from now talking about the trends that we saw in 2023, what do you think, what kind of conversation are we going to be having?
Well, I hope we're going to have a similar one in terms of dining demand remaining very strong. And we watch the data very carefully across the board, just because there is so much noise regarding the economy, and we hear from restaurant partners how hard it is to be running their restaurants. But the hero of the day in this story is that consumers continue to prioritize going out and dining at restaurants.
Hey, Debbie.
So I really hope,
Sorry, 30 seconds left. Does that change, though, in a softening economy? I mean, everyone we've spoken to today is planning on a 2023 recession.
Yes, and we remain bullish about dining. We think that maybe the check size will change, but we think that people will continue to prioritize connecting with others, whether that be family or friends, at a meal at a restaurant.
Debbie Sue, it's always great to check in with you and get a real understanding for what's going on when it comes to restaurants in this economy. Debbie Sue is CEO at Open Table. You know it as a restaurant booking platform. She joined us this afternoon via Zoom from San Francisco. You're listening to Bloomberg Business Week. Tim Stenevik and Katie Greifeld. Check of how stocks closed today. The S&P finishing up at 39.90, up by 1.43%. The NASDAQ higher by 1.3%. You're listening to Bloomberg Business Week, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Oracle shares are advancing after hours and after earnings. Oracle reporting adjusted revenue for the second quarter that did beat the average analyst estimate. Oracle's second quarter adjusted revenue came in at $12.28 billion. The estimates for Oracle were $12.02 billion. Again, after hours, we've got Oracle up now by roughly 2.3%. The Dow, the S&P, and NASDAQ all surged today. In fact, we closed at the best level of the day. The S&P now at 3990, up 56 points today, up 1.4%. Stocks advanced as investors gear up for tomorrow morning's reading on consumer prices. Complete coverage, as you have come to expect over the years from Bloomberg Radio. The CPI drops at 8:30 a.m. Wall Street time. The Dow up today by 528 points, up 1.6%, ending the session back above 34,000 at 34,005. NASDAQ up 139, up today by 1.3%. 10-year yield 3.61%. The 2-year 4.38%. Spot gold at $17.81 the ounce, down 0.9%. West Texas Intermediate crude up 3.5% today, $73.50 for a barrel of WTI. An up day on Wall Street ahead of the CPI report tomorrow morning. Again, the 10-year 3.61%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Well, I talked a little bit about how Tesla stock has been under pressure lately, especially today. There's no clear reason, but the question could be, is it Elon Musk's tweeting? Well, Elon Musk's tweeting might have other implications as well. It's kind of hard to describe him, but I think the way that Josh Green, our national correspondent for Bloomberg Business Week, does in Bloomberg Opinion today as chief troll is a pretty good way to do so. He's got a new column out. You can read it by typing OPIN GO on the Bloomberg terminal or find it at bloomberg.com/opinion. Josh joins us this afternoon on the phone from Washington, D.C. Josh, good to have you back with us. How are you?
Doing well, thanks.
Yeah, thanks so much for joining us. So you write that Elon Musk is ruining Trump's presidential campaign. It's really interesting because if I were a betting man, I would have thought, you know what? If Elon Musk lets this guy back on the platform, if he replatforms him, he's going to be tweeting, and we haven't been seeing that.
Yeah, I would have thought so too. But I think what's happening, just in talking to some Trump folks, is that Trump, as desperate as he's been to get back on the platform, doesn't want to leave Truth Social, the alternative social network that started up that he has a big equity stake in, to come back to Twitter, because I think he understands, or the people around him understand, that if he does do that, it'll sort of zero out the value. Like the whole rationale for having an alternative right-wing social media platform was to get kind of people to go over there and be able to turn that into a business that makes a lot of money, and Trump has a chunk of that. The minute everybody starts gravitating back to Twitter, and certainly if the biggest power user of them all and Donald Trump were to go back, it would really obviate any sort of a need for a right-wing social platform. So I think that's about the only thing that's kept him from going back. But in his absence, a new Twitter overlord has emerged, and that is Elon Musk. And as I say in the column, he's essentially overshadowing and eclipsing Donald Trump, whose political superpower always has been to be able to dominate the political conversation largely through the use of Twitter.
So I'm hearing you talk, I'm reading your column, and it brings me to a natural question, which is, how does this end? Are we going to be watching Musk's campaign in however many years?
I don't think that Elon Musk has any real interest in politics besides just kind of weighing in with his takes, which he seems to be doing about every 30 minutes on Twitter, from what I can tell. And I would never hazard a guess to predict, how Trump's campaign is going to go. But I will say this, what first elevated Trump, in national politics was his ability to draw all the attention to himself, to just be this constant churning story that you couldn't look away from, that eclipsed everybody else, and that drove the news cycle on Twitter, on cable media, on newspaper headlines. And the one thing that Trump has really lost since January 6th, since he was deplatformed, was his ability to do that. He just doesn't have the outlet he once did. And as we can see, he launched his presidential campaign 3 weeks ago, and it's pretty much been crickets ever since then. He really, the only real topic of conversation was his dining with white nationalists, and that's sort of not the kind of press that you want when you're trying to launch a White House bid. But what has replaced that, the guy who is driving the news cycle all day and all night, is now Elon Musk. And if that lane is occupied by Musk, it's going to make it awfully difficult for Trump to become what he once was.
Well, what if that lane is occupied by Elon Musk, and then Elon Musk then goes and decides to get behind someone like Ron DeSantis, for example?
Well, I think it's problematic for Trump, and you can see this in all sorts of ways. I mean, in the column, I looked at Twitter followers. Musk has 50 million more. I looked at Google search mentions. Elon Musk is easily eclipsing Donald Trump. But I think what's even more important from a political standpoint is that if you go to a place like Breitbart News, the hard right news site to help launch Donald Trump, they now have a vertical on Elon Musk, and they're writing about his Twitter stuff every day. And Trump is almost an afterthought. He's sort of buried at the bottom of the page. He's not interesting or new anymore. He's not fun and exciting. And I think most important of all, from a kind of a MAGA standpoint, is that he's not out there causing controversy and upsetting Democrats and owning the libs, which is what Elon Musk is doing, which is irresistible to the kind of online contingent of Trump fans that elevated him, to national prominence in the past. And I think who Trump is counting on to do it again this time around, they seem to have abandoned him, at least for the time being, for Elon Musk.
So it's so interesting. You have data in here to back that up, that Musk is upsetting the Democrats. If you look at NBC polls and the like, the Democrats, like you say, voters think he's Darth Vader, which is interesting because at the end of the day, I mean, he's just like a super rich guy with a bunch of companies.
Yeah, he is. In the past, he'd always been a super rich guy who was sort of, interesting and made cool things and was controversial, but wasn't sort of obviously political in any way. But for whatever reason, he's gone out of his way to kind of reveal himself as a right-wing troll, and it's certainly gotten the reaction that I think Musk was intending to get, because the Democrats are up in arms. A lot of Democrats in Congress want to kind of haul him in and question him. He's become kind of the chief bad guy for the American left. And it's a position much like Trump that he seems to revel in. He loves the notoriety and the attention. It's not really clear to me how this is going to help Twitter succeed as a business, or what Musk's end goal might be. But I think one thing we can conclude in terms of the political effect in the near term is, like I said, it's put a damper on Trump's presidential race. And part of the effect of that, I think, is that it's going to open up a lane for other people to run for president and really get the attention that Trump has prevented other candidates from getting. So whether it's Ron DeSantis, who Elon Musk has spoken favorably about, or somebody else, I think that it's much easier to imagine somebody new taking over the Republican Party today than it was a month ago before Elon Musk took over Twitter and started tweeting in earnest.
Yeah, it's pretty remarkable to see what the shift that has happened, and the way that the kind of echo chamber has been filled by Elon Musk. Josh, I should note you are the author of Devil's Bargain, Steve Bannon, Donald Trump, and the Storming of the Presidency. The book came out back in 2017. It's a New York Times bestseller. You spent a lot of time reporting on the space in this area. What are your sources telling you about the way they think about Donald Trump right now and potentially throwing their support behind someone else? Because if we were having this conversation back in 2015, there were a lot of people saying, okay, Trump is never going to get past the primary. And then as soon as he got past the primary, everybody threw their weight behind him.
Yeah, I mean, I called the subject of that book actually for this column Steve Bannon, because, as a former Trump Svengali and as a former Breitbart News, editor-in-chief, I felt like he has a better sense of the MAGA psyche than anybody else. And he was fully on board with the thesis that Elon Musk has studied Trump and knows how to say outrageous things and drive the news cycle. I thought what was interesting was the way he kind of boiled it down to a media story. He told me a story that I only partially recount in the column about how he used to sit with Trump in the White House watching CNN, and when Trump would get bored, he would say, hey, watch this, and he would tweet. And a couple minutes later, CNN would pick up the tweet and start talking about it. The point Bannon made to me was that Elon Musk has that power now. He starts tweeting about Hunter Biden, and suddenly the news media is covering that story. He starts tweeting about Anthony Fauci, and the media kind of moves over there. So it's really interesting the way that Musk has sort of emulated that. What's sort of puzzling, and even Bannon hasn't really figured out, is how much of an impediment is going to be to Trump, and what are really going to be the effects in the Republican primary. If Musk were to champion a particular candidate, you'd have to imagine with the media reach he has now that would go a long way toward helping that person. So far he hasn't, but his interests seem awfully fickle and seem to kind of change every day or every hour. So there's no reason to think that he couldn't at some point.
Well, if he were to back Trump, for example, would this sort of right what's wrong in terms of Trump becoming irrelevant, or does this speak to a broader issue with Trump that we haven't really been hearing a lot about him?
I don't think that Trump necessarily needs Elon Musk's endorsement. I mean, Musk opened the door to get him back on Twitter if he wants to go back, and he's chosen not to so far. I think what's more dangerous to Trump, and this goes beyond just Elon overshadowing him, is that he's no longer, interesting and exciting and vital. When Trump came on the scene, he was this transgressive boundary breaker, but he also had a lot of things he wanted to do. He talked about trade, he talked about immigration. Trump these days is sort of devolved into kind of complaining about the 2020 election, which really isn't that interesting to people.
Right.
And I think that there's been a broad sense among Republicans, and you saw this in the results of the midterm election, that just isn't a message that interests people, and so he's faded into the background.
Josh, we got to leave it there. National correspondent Josh Green for Bloomberg Business Week. Check out his column, OPIN Go, on the Bloomberg Terminal, or find it at bloomberg.com/opinion. To world and national news we go. Washington, D.C., we find Nancy Lyons. Hey there, Nance.
Thanks, Tim. Lawmakers still have work to do before they can go home for the holidays. They're facing a midnight deadline this Friday to fund the government and avoid a shutdown. But it is likely that a short-term extension will be needed. Also on the agenda is Senate action on the annual defense spending bill. The House has approved it, and if senators do the same, it'll then go to President Biden. Well, just days after fellow moderate Democrat Senator Kyrsten Sinema announced she was leaving the party and registering as an independent, West Virginia Senator Joe Manchin was asked by reporters today if he's next.
I have no intention of doing anything right now. I mean, whether I do something later, I can't tell you what the future's going to bring.
Manchin maintains he's already the most independent person in the Senate. President Biden and the First Lady are getting into the holiday spirit. They went to a military post in nearby Virginia to laud the Marine Corps Reserve's Toys for Tots annual drive that last year distributed 22 million toys to needy kids.
The president spoke directly to the children of service personnel, noting his own experience as the parent of a deployed Army officer.
You have to be brave. Even when your mommies and daddies are far away, they are so proud of you. And I'm so proud of you as your president, all of you here today. And you are the inspiration. So all of you kids, keep on being brave, keep on being involved, keep on helping other people.
The president noted that the toy drive has been going on now for 75 years, and there have been toy collection boxes in the White House and Executive Office building. In Washington, Irv Chapman, Bloomberg Radio.
The Hollywood Awards season is underway. The Golden Globe nominations are out today, with the black comedy The Banshees of Inisherin topping the pack. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We begin with a headline from the Bloomberg Professional Service. Bahamas is probing FTX local clients' withdrawals during the implosion. This update brought to you by SEI. Visionary asset managers find opportunities where others are challenged. Exploit disruption's potential with SEI's global operating platform. Find out how at SEIC.com/IMS. Oracle shares now up by almost 3% after hours. Oracle reported quarterly sales that exceeded analyst estimates on a strong effort from its Cerner digital health records unit, overcoming softer demand for information technology services in a choppy economy. Stocks advanced with investors gearing up for tomorrow morning's reading on consumer prices. The Dow, the S&P, and NASDAQ all advancing into the close today. Stocks gained as investors place bets ahead of the CPI reading. Jake Jolly is senior investment strategist at BNY Mellon Investment Management. And right here on Bloomberg Business Week, he was asked about the economic outlook.
When we look ahead, all of the forward-leading indicators suggest that the economy is slowing down, right? We're still in this situation where the labor market is too tight. Wages are growing at a rate that is inconsistent with getting inflation back down to target. So we think that the Fed is going to have to keep pressure, keep rates higher for longer. That means that the economy is going to slow.
And, of course, complete CPI coverage on Bloomberg Radio and Television. That number drops tomorrow morning at 8:30 a.m. Wall Street time. S&P up 56, now at 39.90, up 1.4%. The Dow up 528, back above 34,000 at 34,005, up 1.6%. NASDAQ up 139, up 1.3%. 10-year yield 3.61%, with the 2-year yielding 4.37%. Spot gold down $16 the ounce, down 0.9%, $17.81, while West Texas Intermediate crude up 3.4%, $73.42 a barrel. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Tim Stenovic and Katie Greifeld were live in the Bloomberg Interactive Brokers studio. Katie, have you done your holiday shopping this year?
No.
Okay.
Have you?
No.
Okay.
But you know what could make a good gift?
Go on.
A watch,
Yeah.
perhaps a timepiece, as some people call them.
They are timeless.
Well, I did say that we'd be checking in with a trio of CEOs today. We already heard from the CEO of Open Table, and I wanted to check in with the watch industry right now and get an idea for really how things are looking across the industry. And for that, we turn to Arjun Vandewaal, who's Chief Executive Officer of Watchfinder & Co. Arjun Vandewaal joins us via Zoom from London. Arjun, good to have you back with us. How are you?
Thank you for having me. I'm doing very well. I hope the same with you.
Yeah, we're doing well. Hey, I'm wondering how the landscape is looking for you as CEO of Watchfinder, because we've heard stories throughout the year with the decline in asset prices, including the decline in crypto, that we've seen a little bit of pressure when it comes to luxury timepieces. What can you tell us?
Yeah, I think we've come off a year of incredible growth in 2021. And at the beginning of this year, we've seen a bit of a reversal, especially if you look at the incredible increase in watch valuation. And that's not necessarily across the board. It's more in what we would see as the speculation watches that traded well over retail in towards the beginning of this year. And in that segment, we definitely see some slowdown in demand and a drop in prices. And I think there is some comparison with crypto to be made. But at the same time, we still see very strong interest across the board. But the weight is a bit shifting in terms of the price points and the brands that are doing well.
So the narrative that we often hear when we're tracking the consumer is that luxury is one of the last segments to crack when you're in a period of high inflation, when you're in a recessionary period. Does that extend to the sort of watches that you're selling as well?
Yeah, I think so. The function of pre-owned is a bit different over time. So traditionally, I would say that pre-owned is a great, and that's the segment that we specialize in. And pre-owned traditionally is kind of the gateway into luxury, where you can get a luxury experience and the quality of product that is very close to new, but at a friendlier price point. And over the last 2 or 3 years, we've seen scarcity, not just with Rolex, but with other brands and series coming up. And we saw that the secondary market prices were significantly over retail. And that's not necessarily how pre-owned is intended. So there's definitely a speculative aspect to it, and that's the segment that is being impacted today. But the undercurrent of pre-owned to get that experience at a more friendly price point, that is still very healthy. But it's likely that we'll see some further pullback on prices, yes.
How should pre-owned be? I mean, because some things that are sold, if they are luxury collectibles and they are pre-owned, they sell for much more than they would cost to buy them new.
Yeah, clearly. I think you can invest in watches or collect watches for various reasons. And clearly in the last years, watches have become more and more of an asset in themselves. And if you make the right investments, then there is potential for significant return. But as you have seen over the last months, there's also the risk of a pullback. So first and foremost, our recommendation is to always invest in watches that you enjoy holding. And beyond that, the reality is that although there is scarcity, there is still very significant supply. And at the moment that prices drop, that's when more and more of that supply hits the market. And that's when prices become more under pressure. So there is, the question is, what is, if you are purely in it for the investment, what is the right time to sell? And I think we're now going through kind of the aftermath of the incredible increase that we've seen in the last 24 months.
Well, let's talk about collectibles and the environment that we're in and how the collectible market shifts during times of, maybe we're not in a recession now, we're waiting for the official word, but in past recessionary periods, how does the collectible market for watches, for pre-owned watches, typically fare?
Well, first and foremost, what you'll see is that there's an increase in supply, and that's what we've been experiencing over the last months, especially in the segment that we would describe as more speculation watches with Rolex Daytona, for example, very desirable pieces that trade well over retail, sometimes 2-3 times retail. And with supply going up in the market, then we see pressure on price and pressure dropping. So that's typically the first telltale sign, and that's what we've been seeing over the last months. Where those prices settle, that is to be seen. So if you look at the Daytona, which is the quintessential pre-owned piece, or the most desirable and still accessible model, 5-6 years ago, that was the only model that structurally traded above retail. Pretty much all other watches besides the unique pieces were all trading below retail. And if you look at today, then the market as a whole is still significantly above where we were 5 years ago.
Hey, Arjun, I want to get back to what exactly you do at Watchfinder and the way that you sort of meld the online and in-store experience, because you recently expanded the partnership with Nordstrom. Talk a little bit about how you work with retail just in the last minute that we have, because you can see everything you offer online. Why is retail important?
It's very important for us to be close to our customers. There's also the trust aspect that it's in general, it's quite a large investment that our clients make. And with such an investment, a lot of clients want to hold the piece before actually making the transaction, or they want to have the opportunity to pick up the piece in person. And for us, partnering with Nordstrom is an incredible opportunity, not only because of the reputation and the presence that Nordstrom has in the US, but also the geographical footprint. So we started in Seattle in the Nordstrom flagship boutique last year, November. We've now opened New York, and we've opened 2 pop-ups, one in Arizona and one in California. And we're planning to further roll that out across the United States. And we've really learned that those customer journeys are becoming more and more omni-channel.
Hey, Arjun, we got to wrap it up, but in 5 seconds, the watch you're wearing right now, what is it?
It's a Grand Seiko. It's a beautiful Japanese watch. Yes.
Very cool. Arjun van de Walt, CEO of Watchfinder & Co., joining us via Zoom from London.
It is 4:53 on Wall Street. I'm Charlie Pellet with today's headlines. Oracle is reporting quarterly sales that exceeded analyst estimates on a strong effort from its Cerner Digital Health Records unit, overcoming softer demand for information technology services in a choppy economy. Sales were up 18% to $12.3 billion in the period ending November 30th, compared with average analyst estimates of $12 billion. Shares after hours up now by about 2.7%. Goldman Sachs Group aims to cut at least a few hundred more jobs as the Wall Street giant restructures its struggling consumer business and braces for an uncertain economy in the year ahead. Sources tell Bloomberg the bank is drafting plans that could eliminate at least 400 positions from its loss-making retail banking operations. Goldman Sachs up today by 1.1%. New York Attorney General Letitia James has announced two multi-state settlements totaling $10.7 billion with CVS and Walgreens for the pharmacist's role in the opioid crisis. Sears Hometown Stores has filed for bankruptcy protection. This according to court papers seen by Bloomberg. The retailer listed analysts of no more than $50 million and liabilities of at least $50 million in its bankruptcy court petition filed in Delaware. Chapter 11 bankruptcy, it does allow companies to continue operating while working on a plan to to repay creditors. Amgen buying Horizon Therapeutics for about $27.8 billion. And those are some of the company stories we're following this hour. This is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
It's Bloomberg Business Week. Tim Stenovic and Katie Greifeld live in the Bloomberg Interactive Brokers studio. Let's go over to Nancy Lyons for Check the Latest World and National News. She's in our 99.1 studio. Hey, Nance.
Thanks, Tim. AAA is out with its travel estimates for the holiday season. The number of Americans heading to their destinations by car, plane, and rail are all on the rise. Ellen Edmonds is the association's external communications director.
This holiday season, air travel will see a jump over last year, increasing 14%, with 7.2 million Americans expected to fly. Flights and airports will be bustling and look a lot like they did pre-pandemic.
Edmonds says the number traveling by car is expected to be up 2% from last year. The European Union is hoping to reach a deal tomorrow on its plan to wean itself off Russian fossil fuels. Belgium's Energy Minister Tinne van der Straeten tells Bloomberg gas supplies seem adequate for this winter, but leaders will need to address future supplies.
We have filled our storages, we have decreased our demand, and yes, there is another winter coming, and preparation of the next winter is also being done now. Like, for example, joint purchasing of gas is something that will be discussed tomorrow at the Energy Council.
Belgium's Energy Minister Tinne van der Straeten. Scientists in California have made a breakthrough in nuclear fusion technology. Bloomberg has learned that for the first time, they've produced more energy than consumed in a reaction. It took place at the Energy Department's Lawrence Livermore National Laboratory near San Francisco. Former EPA Administrator Christine Todd Whitman tells Bloomberg it's an exciting development.
This is a big step forward, and fusion can certainly offer a major tool in the efforts that we need to make to address the issue of climate change and what's happening in the environment.
Whitman says while the results are considered an achievement, we're still a long way off from creating a viable technology. The Keystone Pipeline that carries oil from Canada to U.S. refineries is still shut down after a major oil spill, and officials with TC Energy say they're not sure when it will be restarted. The company will need regulatory approval first. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. Back to you, Tim and Katie.
Thank you so much for that update, Nancy Lyons. I really do appreciate it. Hey, I want to talk a little bit about real estate here in New York City. There's this story out by our own Natalie Wong on the Bloomberg Terminal about how JP Morgan Chase and Mac Real Estate Group are financing a loan backed by 2 New York City office towers. The lenders, Katie, are providing roughly $326 million in financing to the SAPER organization for the buildings at 260 and 261 Madison Ave. That's according to a statement on Monday. The agreement has a loan-to-value ratio of about 65%.
So these buildings specifically, they were purchased by SAPER in 1997. They feature roughly 1 million square feet of office space in the middle of Manhattan. Tenants include law firm McLaughlin and Stern and the SAPER organization's own headquarters. Earlier this year, MGM, Metro Goldwyn Mayer, I haven't seen it spelled out like that, signed a lease at 260 Madison Avenue.
I just want to get to one more story before we go, Katie. Oftentimes, at this last part of the day, we like to take a look at what the most read stories are on the Bloomberg Terminal. This story has been getting a ton of attention this afternoon by our own Srinath Rajan about some changes at Goldman